Limited Q1, Q2 and H1 FY22 conference call. The call will be initiated with a brief management discussion on the Q2 and H1 performance, followed by an interactive Q&A session. Management will be represented by Mr. Prakash Joshi, Whole-time Director, and Mr. Prateek Bera, Chief Financial Officer. Over to you, Prakash, for your initial comment.
Thank you, Ankur. Thank you so much for visiting us. Good evening, everyone. I am Prateek on behalf of Clean Science and Technology, and I would like to wish everyone a very happy Diwali. I trust all of you are in good health and all of you are safe. For the benefit of participants who are hearing us for the first time, let me give you a very, very quick introduction of Clean Science and Technology. So Clean Science is a highly differentiated specialty chemical company with very high focus on R&D and innovation. Here in our Clean Science, there is a lot of focus given on focusing on developing newer innovative chemistry processes. And due to this, we have emerged as a key global supplier for critical specialty chemicals within the span of last 15 years. 20% of our revenues comes from export market, with a sizable share coming alone from China market, which is one of the most competitive markets globally. We enjoy meaningful gross margin of about 68% despite of the high inflation, the logistics problem, and all these scenarios which are currently prevailing. Our sales are typically derived out of three key segments. One is performance chemicals, which comprises 70% of our sales, which comes out of NASP DHA. Which comprises about 15-16%, which comes from aerosol and DCC. And third important segment is FMCG chemicals, which comprises about roughly 14% of our sales. Besides creating innovative chemical processes, our value chain is backward integrated to basic commodity chemicals, including phenol, methanol, acetic anhydride, cyclohexane, to name a few. Differentiated process and backward integration ensure that our gross margins remains resilient. The testimony to this competitive advantage is our healthy gross margins, which are at 68% despite of key raw material prices increasing by over 60% compared to pre-COVID levels. This strategic move and this quarter particularly has been a very consolidation case for us, where we have not passed all the raw material prices increase to our customers. This, I believe, has given us a very high goodwill with our customers, who in the coming financial years will give us a higher wallet share of their requirements. Our endeavor is to be a premier partner of choice for our customers. ESG, of course, is one of the most important criteria in this company. Our entire processes are designed looking at cleaner and environment clean processes. To also ascertain this, we are undergoing a very high certification body called as the Crore. Very few companies in India have been certified by this certification. As you might not be aware, but Crore evaluates commitment of the company towards environment friendliness. It basically determines the amount of carbon dioxide emitted per metric ton of chemical products produced by any organization. We estimate this certification should be completed by H1 FY22. On CAPEX, CAPEX is underway towards our Unit 3, which we are expanding our current existing products line by about 50% and adding very new range of product called as HALS, HALS, which signifies Indoramine Light Stabilizer. To this end, we have entered into an agreement to acquire 34 acres of Crore, which is Unit 4, for our greenfield CAPEX. It is the largest CAPEX till date of the company. During the first half, FY22, we have incurred a CAPEX of about 75 crores, and the CAPEX commitment continues to be strong with over 100 crores annually, and all has been done with internal accruals. A little bit on HALS for the newcomers. HALS stands for Indoramine Light Stabilizer. capitalizing the new cities which we are launching. We find application in diverse industries including water treatment, paint industry, master batches, polymerization inhibitor, etc., etc. We will be the first Indian company to manufacture HALS in the domestic market. The global market size for HALS is estimated to be about $1 billion and growing at about 7 to 8% CAGR. And we endeavor to be key player in this segment within the next 3 to 4 years of our launch. Give a little light on the quarter 2 FY22. We reported highest ever revenue of about 153 crore, which is 9% higher than the last year quarter 2. Despite steep increase in input prices, the raw material prices, logistics prices, power and utility like coal prices, are still gross margins and PBT margins remains at 68 and 47% respectively, with PAT of about 54 odd crores. Balance sheet, of course, continues to be debt free with a cash balance of approximately 275 crores. On the outlook, our company is undergoing a consolidation phase where sizable CapEx is underway towards existing and new products. We will continue to follow prudent policy about CapEx capital expenditure program and cash management everywhere. We see sustainable growth environment in our business by introduction of new products and planned capacity expansion. We are confident that our focus on our process innovation, backward integration, and operational excellence will help us navigate through the inflationary cost environment. The company is always working towards increasing its global presence by expanding its markets into newer geographies, business segments, and product portfolio. So this is all from my side, and I am now open for any questions and answers you guys might have.
Thanks, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. So our first question from Mr. Rohit Nagraj from Emkay Global Financial Services. Please go ahead, sir.
Thanks for the opportunity and congrats on picking up funding in the challenging environment. So the first question, as you mentioned, that there is not that we have not completely passed on the price increases, which are currently given our with the customers. Do you see that we will be passing it on given the increasing rise in the raw material cost still underway and currently the cost will reduce only after 3 months? And that will probably help in terms of Q3 and future margins. So you are hopefully conducted.
Absolutely. So what happened is, let me explain you. So generally our future, the next year contracts of any company start with the month of October, November, December time. And quarter 2 for us was very important to prove to our customers that despite of very high increase in our raw material prices, we are not being over aggressive and passing everything to them. It gives them that confidence that because obviously as we are going down to the end user, the prices of end products have not been, even my end customers have not been able to increase prices of their end product as much as we are able to increase. So everybody in the value chain is trying to absorb the issue cost. And this has helped us in gaining some of the good contracts in the coming years, and of course has given a good confidence to our customer. But going forward, the new contracts which will come in place will have these price increase incorporated in them.
Got it. And that's good to know that you have the ability to pass in the subsequent quarter. The second question is about the CapEx commitment that we have. So we have the new non-custom green CapEx. Now, in terms of this new manufacturing, how much is CapEx commitment can be accommodated over the next few years? Now, this is just from the perspective that our land bank or our facilities are located adjacent to each other right now, and whether we will be looking at some other places eventually when we say outgrow the current size. From a 3 to 5 year vision perspective. Thank you.
Yeah. So right now, of course, I think you're asking questions pertaining to Unit 4, which is about 34 odd acres. One of the reasons of selecting similar MIDC area is our ability, all the local issues, understanding the labor problems in that particular locality, and because of our proximity to our offices, it gives us a very good angle when these units are closer to each other. So that is a very big advantage. We were very fortunate to get a very good piece of 34 acre of land. It is not taken from the government, it is acquired from some private paper. So the discussions have been going on, but finally it got completed. That is number 2. Number 3, I think the 34 acres will come up after, the capex could be approximately over 300 crores. In the first software, it will be phase 1, phase 2, phase 3. As and when new products also come online, these will be incorporated into the 34 acre of land with a very large parcel of land. But the phase 1, which we are very confident will have about 150-175 crores of capex. And phase 2, I think, will also be in similar range. And then phase 3 will come when we have more products which will come out of our R&D.
And then just one last clarification, if I may. Could you just explain a little bit more on our R&D initiatives and in terms of our R&D bandwidth, investment into it, we will want to set up a separate R&D facility, given that our focus has been predominantly on technology and our aim processes form. Thank you.
Absolutely. So R&D has been a very, very key parameter for the organization. I directly look into the R&D of the company. We are currently 2 R&D, and the third new R&D is going to begin. It's already started. I think we just did the puja on Dashera, and the new boys are joining in, and we will have a new segment of R&D coming up there. That is 3. In R&D, we are specifically focusing on 3 very large categories. One is the stabilizer, where the entire focus is given on this high segment, because it comprises a variety of products. So like we have already done some of them, like 701, 706, 22. There are more coming up, like 944, 2020, 1111. So all these products are looked after as an individual segment. Number 2 segment on my R&D guys are working on is intermediates for agro and intermediates for pharmaceuticals, which is what we have already been doing. So there is another segment of people which are working on this, and of course one segment is already working on existing business lines where we are trying to further increase yield efficiency and processes of our existing businesses which are currently working on.
Okay, got it. Thank you so much, and the second I will come back to you.
Thank you so much.
Thank you, sir. Our next question from Mr. Ankit Jain from Future Investments Private Limited. Please go ahead, sir. Our next question from Mr. Ankur Jain from Future Investments Private Limited. Please go ahead, sir.
Thank you so much for taking my question. My question is with respect to your R&D. So what kind of products are we looking to manufacture in the next 3 to 5 years? R&D is that I'm sorry. For us, the most important is not on the segments, but we particularly put emphasis on process innovation. So we look at a particular molecule which is where India is dependent predominantly on China, or where imports are coming from other parts of the world. And we try and figure out if we can come up with a better, cleaner, innovative process, which is what we have done over the past 15 years. So to give you a reference, the R series which we have come up up with. It is a very complex chemistry where we are starting with the most simplest raw material, mainly acetone and ammonia, which are both less than $1, and we are going to make the entire segment of affairs, which comprises of several products ranging from $7 to $15. It's a multiple step processes which we have deployed. Similarly, on pharma intermediates, the agro intermediates, also similar thought process is used where we try and see if we are able to come up with better processes, hence we are able to convince the customers to switch to us compared to the existing suppliers of them. Okay, thank you, sir. My second question is with respect to the gross margins. So, everything that you have found from the gross margin completely. So, are we looking at the gross margin coming back to what they were in the previous quarter in the coming? Absolutely. Because some of the factors, let me explain, that even during quarter 1 and quarter 2, there was steep increase in raw material price, which was really unthought of. I mean, power issues like coal. Coal in itself ran up 17% over the last 2 quarters, which was absolutely unbelievable for us. Hence, it was very difficult to anticipate these situations and keep passing the prices to the customer, because we generally want to be not a supplier who keep changing the contract as the price keep revising. So if a contract is taken, we would like to respect that contract. But going forward, these scenarios are evident globally, and these are the problems which everybody is facing, and hence even the customer is now understood, and even they are beginning to discuss new prices with us. Okay, sir. Thank you so much, and all the best. Thank you.
Sure. Our next question is from Alisha Mahabala from Envision Capital Management.
Hi, sir. Good evening, and thank you for taking my question. So my first question, what is the current capacity utilization level?
Hi, Alisha. Across performance chemical segment, the capacity utilization is in the range of 70%. DHT being higher, followed by DHA. Second, pharma chemical segment, where Qualcomm's capacity utilization is in the range of 20%. DCC is clearly ramping up. It's in the range of around 35%. And after the FMCG and demand utilization is in the range of 65 to 70.
Okay. And so last quarter you mentioned that in FMCG chemicals, so one of our products, you were seeing some demand contraction. Has that normalized, or are we continuing to see that?
So last quarter, I think we saw some improvement. I'm really hoping that quarter 3 or quarter 2 should be better, unless there is some major lockdown which happens, because the products of FMCG, pouring boxes, acetophenone, goes into cosmetic, like a sunscreen product. So sunscreen is majorly a product which people would apply on vacation when they are, going out in the sun and all those things. So that segment is a little disturbed right now, but for Q2 and Q3, we've seen reasonable demand coming back. But the only hope is that there shouldn't any other lockdown should come up again. Otherwise, I think this segment should come up very well again.
Sure. And just to clarify, this capex that we're incurring is only for unit 4. There's no other capex that we're currently looking at, correct?
So we are also doing capex in existing unit 3, right? So there are 2 capex companies simultaneously coming. Capex in unit 4 will typically begin after March once we get a climate clear. Till then, we are only buying the land. Okay, so advance of about 10 crore is paid to the owner, and balance should be paid on due diligence. And capex right now is happening in existing unit 3.
So what is the capex we're doing in unit 3? The amount of quantum?
The 75 crore almost हो गया है, and we are anticipating additional. Okay, would be around 100-ish, so around 30 crore more would be done in the over 6 to 7 months time.
Okay. And this all will be ready for use by end of the year?
It is coming up with phase-wise plans. Some of the plans will start in December, some are starting in March, April, some will start in September. different lines. Yeah.
And this is when you're expanding 50% of our capacity for existing products plus doing the new HAL.
Absolutely. Perfect.
Okay. And then in unit 4, that is something I think we will define later once the increase in place, or have we defined what kind of CapEx we're looking at?
Basically, the balance has, as I mentioned, is a series of products. Right now, we are coming up with only 2. In unit 4, additional 5 will come out. And some pharma intermediates which we have already been successful in that will also come up in unit 4. This is planned for my phase 1 of about 150 crores.
And if we start
June 23.
June 23 when the plant will be ready.
Hopefully, yes.
Okay, understood. Okay. And can we expect asset turns for the CapEx we're doing in unit 3, the 100 crores to be similar to what we're continuing, 2.5? 2.5, I believe, is our asset turn currently.
You can estimate English.
Sorry?
3.
Okay, understood. And just one last question. If I see our current run rate, while I do understand the challenges that we are facing, but it's not because of any contraction in demand, we're running slightly short of the kind of growth, annual growth that we historically used to show. So are we correcting H2 to be stronger?
Yes.
Or H2?
The reason is, one of the major reason is Q2 also has a lot of shipping issues, logistics problem. Same was in Q1. Q2 was also similarly bad. But now, in Q3, at least we are not seeing those issues as we had seen in Q1 and Q2. So my real thought remains that Q3 and Q4 should be better than H1.
Okay. And just one last question, if I may. What is the kind of price hike that you've taken in this quarter or in H1?
So it depends on product to product.
Sorry?
It depends on product to product, but still the price range has been increased from 3 to 8%, 3 to 10%.
In H1?
In Q2 ending, and these results will be seen in Q3.
Okay. Okay, great. Thanks, I'll get back in the queue. Thank you.
Thank you. Yeah.
Thank you, sir. The next question from Mr. Dipesh Gupta from Kotak Securities. Please go ahead, sir.
Yeah, hi. Thanks for taking my question. Congratulations for the existing and kind of reasonably well managed, but anyway. I think I had a question in terms of the new capacity that was coming up for your products, for your core products, and when does that get commissioned, the volume expansion for your products. And the second part is that, if I understood you correctly, I just kind of rechecking what you said so far, that you already taken price hike and from quarter 3 onwards, you would go back to your old gross margins. Is that correct understanding?
So Dipesh, let me answer your first question. So the capacity expansion should start, the plan should begin by March, April 2022. That is question 1. Answer to your question 2 is, if the raw material remains at these levels, and yes, we have given price hike, but tomorrow there is further price increase happens. Yeah? Then again, the margin would be at similar levels. Because today it is very difficult for me to sit and predict, because over last quarter to this quarter, say for instance, phenol for that matter, grew by 13%. Okay? Tertiary amount grew 25%. This has been absolutely as a normal. I have not seen this situation over the last 13, 14 years, where quarter-on-quarter prices are increasing by 25%. Okay? The situation, I believe, is now going to get better. Things should start stabilizing. Then, of course, the margin build-up will start happening again to the earlier level. However, I still anticipate that the RMC prices should still be closer to 31%, which in quarter 2 is 31.7%.
So this, the price hike that you can already take into account whatever sharp increase in gold prices that you saw in the month of September and probably later on, and probably some of the others that you must get where you saw a sharp increase towards the end of quarter 2 and probably beginning of quarter 3 as well. all actually positive. Absolutely. And the next one is that, the competition has been ramping up, their capacities and their volumes. Have you seen any increase in competitive intensity, etc., so far, or you have seen any kind of volume-related issues, etc.? I can only tell you that we are running full, reasonably full capacities, and I think Q3 and Q4 remain strong. Okay. That's it. Thanks, sir. Thank you so much. Thank you very much.
Thank you, sir. Our next question is from Mr. Srinivas Iyer from Rockford Consultancy. Please go ahead.
Good evening, sir. I have two questions. One is, you mentioned that capacity utilization is 70%. Why is it not fully utilized? And when we are expanding the capacity, why existing capacity is not fully utilized?
So, optimal utilization levels between the range of 81%. So, at level of the 85% level. And we are expanding capacities only in those products where the utilization levels are optimal. For instance, in FMCG chemical segments, we are not planning to add any additional capacities for now.
Okay. The second question, in the last conference call, you mentioned that environment clearance will be available by January, but this time you are telling by March.
Right.
What are the reasons why it is getting delayed?
Yeah, no, it is not getting delayed. Unit 4 earlier was planned on 17 acres. But okay, after getting that land from MIDC, we found this 34-acre piece of land, and we thought it is far more better for us for future expansion. Hence, the 17-acre will be sold off, and all inches will now be done on 34-acre. And hence, because the new address has come up, so the new process of EC has begun.
Okay. I understand.
Thank you.
Thank you, sir. Next question from Mr. Sai Kumar from Vigneshwara Consultancy. Please go ahead, sir.
Yeah, hello. Am I audible?
Absolutely.
Yeah. Thank you for accepting it. So I had a doubt in antiretroviral APIs. So can you give us some idea how the pharma chemicals has impacted? Like there is a degrowth. However, there is demand in the pharma antiretroviral API. So can you give us some guidance on how it will be affected further?
So antiretroviral drugs which we may typically go for treatment of herpes and HIV infections. And I think because of lockdown, people are not traveling, and this infection spreads are not happening, and hence the survival market is slower than in general what they were. That is reason one. Reason two is that across the world, every pharma company is still focusing on COVID and COVID-related vaccines and COVID-related drugs. So the emphasis on the validation of a new vendor in a different space is not their priority as of now. But I think over the next 6 to 8 months' time, we'll get approved as in any other pharma company, and there will be a substantial growth in business.
Okay, got it. So I have one more question. So how would the acetic anhydride affect in the revenue growth, revenue after increasing the price hike last quarter and this quarter? There is a decrement, right? So how it affect, and will there be any possibility of incremental or decremental, just a guidance? It's not a forward-looking statement. Just we need some idea.
So acetic anhydride is so dependent on acetic acid, which is dependent on methanol. Yes, and this has been extremely volatile for the past 1 year. I haven't seen volatility in pricing of acetic anhydride since January. Last month, suddenly methanol prices touched almost 50 rupees.
And today, as we speak, it is at 40 rupees. So these prices of acetic anhydride is not very static even at the moment. And then I will become very difficult to really anticipate whether tomorrow the price of acetic anhydride will go down or will it go up. We have taken an average price and quoted our customers based on that, and the business is happening based on that. But tomorrow, if prices further go up by 25%, it will be detrimental. But if prices come down by 20%, it will be beneficial for us for the existing contract.
Okay, got it. So I had one more doubt regarding the product discovery recently in Hall, ended life stabilizers. Yeah. So I need how the growth in that segment has happened recently after the releasing the statement of recovery of the product. How the growth in that segment?
So growth in that segment is we are still on lab and pilot scale. The construction is going to begin for one of the plants. Just started construction, and the plant will in itself start by June or July 22. And that is when the commercial production of these products will begin.
Correct.
Thank you.
Thank you.
Thank you.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Our next question from Mr. Keshav Kumar from Naxal Investors. Please go ahead, sir.
Good evening, sir. Thanks a lot for taking the question. Sir, I just have one very broad-based question. This year, the Nobel Prize for Chemistry was awarded for developing a tool for very asymmetric catalyst. So, sir, could this come as a deterrent for our company and reduce the cost arbitrage that we have, or could we benefit, or should it not have any material impact? So, the asymmetric synthesis organometallic chemistry has been very popular already. But these chemistries are used where molecules are extremely expensive. For the range of segments which we operate, these segments do not, organometallic catalysts costs are so expensive that products which we manufacture at the range of $5 to $10, these organometallic catalysts cannot be used. These are used for very high iron compounds or very high, high molecule or very high priced molecules. So it has absolutely zero impact on any of our businesses. Sure, sir. That's all from me. Thank you.
Thanks, sir. Next question from Mr. Rajiv Parekh from Excel Securities. Please go ahead, sir. Next question from Mr. Rajiv Parekh from Excel Securities. Please go ahead, sir. There's no response from the number. We move on to the next question. Question comes from Mr. Sanjay Guradia from PEC Investments. Please go ahead, sir.
Thank you for taking my question. My first question is regarding the revenue mix by geography. Could you throw some color on how you had a substantial improvement in revenue to China? So if you could throw some color on what led to this and where do we see this going forward?
So China has been a very, very interesting territory and a very interesting geography for us. And I think this quarter our sales to China has been closely 40-42%. And China has been a very, very favorable market for us. The demand is very, very strong in China, very, very robust. And we only see volumes growth happening in that part of the geography as well.
But that's primarily pertaining to performance chemicals that we are looking at growth?
Performance chemical is one of the major criteria. We export all the products to China, but yet performance chemical has been the largest among them.
And going forward, do we maintain a similar mix or we see this even increasing from here?
No. I think it should be closer to 38, 40 altogether.
Okay. Thank you. My second question will be on the balance sheet. Wanted to understand, since we are now sitting at 60 crore cash and still implement the working capital. Do you think this now will be the main deficit working capital? Do you see further improvements and any thoughts on how we will be utilizing the cash? So the cash utilization strategy, you already mentioned, very well. Also, as a strategy call, we would like to mention one mix of that on cash on board. So besides that, then it will be CapEx consumption, which is already underway. We would also like to continue on some strategic investments which will help us moderate our operating expenses, like we are trying to solar. And dividend is, of course, as a all committed during the IPO. Okay. Thank you. Just one last piece of suggestion, if you could also have another few products to give everything, if you could have kind of a market size education, that will also be very helpful.
Sure.
Thank you. I'll come back in the queue.
Thank you.
Thank you, sir. Our next question from Mr. Rohit Nagraj from MK Global Financial Services. Please go ahead, sir.
Thanks for the call. So for the existing set of products, I understand that our byproducts is water, and so probably the requirement from the fuel treatment perspective will be relatively minimal. But in the next set of products which we are developing and which are currently under development phase, how do you need a good amount of PPP plants and environmental which needs to be taken care of, and which will again have investments going into it, and probably will be for a very kind of plants in the next period of time? Thank you.
So primarily we are focusing again on developing very cleaner processes, number one. Number two, we always get permission for building facilities. Crore is a landlocked area, and the permission given by NPPP to us is always for the facility. And all the plans and all the BTP expansions which we do are with keeping in mind that nothing can be discharged outside of our factory premises. So the water is regenerated back, the salts are sold in the market, and whatever is there has to be utilized in-house or has to be sold out.
Right. Got it. And in terms of the scale-up of hand business, how do you estimate the next 3 to 5 years? Because of that, we will start in terms of calendar year 22. How do you see in terms of maybe growth rate or potential revenue recovery over the next 5 years?
So we are first starting with the as only 701, 770. 701 is a predominantly export market, whereas 770 is a domestic market open, because India is importing close to 3,000 tons of 770, and we would be manufacturing less than 1,500 odd tons. So that we will be only facing like domestic market, and for 701 which is the export markets.
Okay. And so this is the initial phase where we are starting, and then eventually we'll add more products for each of them.
We'll add more products and we'll add more capacity. The existing as well.
And normally, what is the optimal time that we look at from utilizing the capacity?
Typically, I think it should take good 1 year to get approval by all major accounts within India and abroad. So, in year 1, you can anticipate 30 to 40% capacity utilization. Year 2 should be 40 to 60, and year 3 should be 60 to 75. So 3 years is a very good number, 1,000 days, and you start a plan to reach, of course, with your price, quality, everything is a plan. 1,000-day program to get a significant market share is what I assume.
Yeah, got it. Thanks for the check.
Thank you, sir. Our next question from Mr. Ankur Jain from Future Investments Private Limited. Please go ahead, sir.
Thanks for taking my question. I just wanted to know what kind of market share are we looking to capture in the HAL series? As you said, it's another $1 billion market, right? So what sort of market share do we see next 3 to 5 years?
So in 5 years, I think we should be aiming at 10% market share. So that's a great market share.
I am getting
10%. 10%. Okay.
Thank you, sir. Next question from Mr. Anand Sarkar, individual investor. Please go ahead.
This is already answered.
Thank you, sir. Next question from Mr. Sukant Krish, he's an individual investor. Please go ahead, sir.
So, thanks for giving this opportunity. And since some of my questions are already answered, so related to the Halls product, how we can command the margins? Like once we start manufacturing the Halls product, will there be a margin increase or decrease will happen? And what is the margin we command for the Halls product? And the product, is it already integrated with our existing chemistry or entirely we are creating new materials? That is the question.
So one of the raw materials is known, but both the raw materials we are buying for some other product, but that is not really meaningful because these are very basic commodity chemicals like acetone and ammonia. The margins built up typically we have seen happens when the capacity utilization optimization happens, and when a plant is built up, as and when we keep operating the plant for 2 or 3 years, the competitiveness becomes much better, the yield efficiency keep improving over the period of time. So we might start with the reasonable margins to begin with, but I am very, very confident that as we keep moving on, the better efficiency, better operational yields, the margins will continue keep happening.
Okay, sir. So, same question related to the Halls product. So, for Anitol, we have the unique manufacturing process, right? The vaporization technology, so that we are the low-cost producer among the whole world. So, similarly for Halls, do we have any unique technology or we have any unique technology in the account, sir?
So, here, one of the key producers of this series, what we are doing is we are creating. Honestly, it is very difficult for us to identify what process they are using, what are their needs, and what are their efficiencies. But the process which we have developed, I think, is one of a very superior process. And of course, because our operations are in India versus the plant which we have operating in Italy. So I personally believe that our manpower, our overall expenses should be better compared to a global player like we are.
Okay, sir. So in that case, are we not going to patent this also like the vapor technology? Okay.
No, sir, we will not do it.
Okay, thanks. Is there any reason?
So patenting is the same problem as I keep mentioning that you have to divulge so much information that,
Sure.
Thank you.
Our next question from Mr. Roshan Nair from Equentis Wealth Advisory. Please go ahead, sir.
Yeah, thanks for the opportunity. Majority of my question has been answered. So just one question. So how much energy we consume in-house to power the degree to PHE?
Closer to 70, 80 tons is something which we consume ourselves.
Okay. And rest is sold in the market, sir?
Absolutely.
Yeah, thanks a lot.
Thank you, sir. Next question from Mr. Rajashekhar NS. He's an individual investor. Please go ahead, sir.
No, sir. In your commentary, you just mentioned that you have your utilized capacity up to 70%. And the optimal capacity utilization is about 85%. So suppose if you have to expand, if you get more orders, will you be able to catch up with the existing capacity or there will be bottleneck? Could you repeat your question? In your commentary, you just mentioned that you have already utilized 70% of the capacity. And optimum capacity utilization is about 85%. So now you get more orders. If you have to cater to more of the customers, there will be a bottleneck in the next quarter or two. It is not in 2 quarters because our new capacity will start by March. So after that plan start up, there will be absolutely no problem. And tomorrow, if we get very, very large, which I don't believe it should happen, I think it shouldn't be a very big bottleneck right now. Okay, that's right. And my second question is, you told that you to develop a product, you follow a new process, an excellent process. With that, and after that, you will go to the customer for convincing him to take the product from you. In that case, if you are engineering product coming down with your new process, or how is it that you convince the customer? And why did you convince the customer? Pricing is the major criteria. And of course, if better pricing is coupled with green, clean process, that gives a definite, very large impact to customer. Okay, because it starts believing that that you will be a sustainable supplier. If there are pollution problems happening, you will not be the first one the government would ask to shut their plant. And the second thing is, your process and technology is all unique to yours. That's why you don't want to divulge so that if you have the final pages, you need to divulge a lot of things. And with your R&D personnel, you need to rethink your R&D personnel. They should not go out because the knowledge, the responsibility of knowledge is with them. How are you retaining the personnel, or is there any churn on the R&D? So in R&D, a lot of raw materials have been still in coded form. And we manage our R&D in a fashion that all steps are not happening in one particular lab. My last question is, how much of cash you have in mind? No? 275 crores. Okay. Thank you very much. All the best, sir. Thank you. Thank you, sir.
Thank you, sir. The next question from Mr. Nitin Gandhi from IKSIS Trade Capital Private Limited. Please go ahead, sir.
As you said, earlier could be the based on maybe the fourth year would be the peak revenue potential which you will be able to exploit based on all the expansion which you have been planned. So what would be the best potential case revenue based on your existing plans and money which you have figured out for CapEx, including 75 crore now and 30-40 crore in H2 and whatever phase 4?
I think typically once all these plants operate, we should touch a top line of 800, 900 or so.
I thought it will be a little higher because your existing is 600 at 75% and then at 85% is getting around 750. And your existing 100 crore CapEx will give another 3,050 and plus HF.
No, in this 100 includes HF.
Okay, 100 includes HF.
Yes, one part of HF.
In my best case, there is 1,050 crore.
It's better to say less and deliver more.
Delivery and peak potential. And this is the peak potential.
Peak potential भी आप 800-900 से पकड़ी है तो अगर आ गया तो आपके अंदर को दोनों को लॉन्च.
Right. So that means you will need whatever cash flow generation you will start generating from 23-24, we will need to have another big expansion ready to meet whatever the influence generated. Absolutely, 50. Of course, this little 34 acre of land is purchased so that we can do much better expansion than bigger expansion, and we won't have to wait every time for ECs and government and procurement of land. So, thank you.
Thank you, sir. The next question from Mr. Betty. He's an individual investor. Please go ahead, sir.
Hi, my question is already covered. Thanks for speaking.
Thank you, sir. Our next question from Mr. Faisal Hava from HC Hava and Company. Please go ahead, sir.
That's probably the only thing which will shift any kind of danger into the company channel into a product ownership. Can't hear you. Can't hear you. Can you hear me now? आपका आवाज बहुत क्लियर हो रहा है.
If you could please come closer to the mic, Faisal sir.
Can you hear me now? Yes, sir.
Speaking, we're not able to hear you, sir. So, shall we take the next question in the meanwhile? We'll take the next question. Yes, sir. The next question from Mr. Kartikeya Yakin. He's an individual investor. Please go ahead, sir.
Hi, sir. Thanks for the opportunity. So I have one question. So after 3 to 4 years, when all the CapEx is done and everything is ready, is the current margin same?
But if I only start looking at chemical products where margins are 50%, then probably I cannot do anything. So the answer to your question is that our focus is that we should always keep a very healthy ROC, and I think our ultimate goal is to maintain an ROC of 50%. Okay. Sounds good. Thank you.
Thank you, sir. The next question from Mr. Tejas Seth. He's an individual investor. Please go ahead, sir.
Good evening, sir. Yes, sir. Hello?
Yeah. And sir, last year in September quarter, our total material sale is all.
Sorry?
Last year, in the same quarter, our September quarter sale is all.
Also, I'm mistake. Not 480 last quarter was 138, I think. Yes, 139 crores. 139. Yes, 139.
What is the revenue on last quarter? Last year for September quarter?
139 crores. After 2 and 21 and 139.
Okay. Then I will look at it. I think we are looking at we will be coming up with the president chemical as well. So we are using the stabilizer in the president chemical as well.
The stabilizer, I know. The president is not really.
Okay. We are looking at the segment that you have mentioned, which are physically. One, the active from the stabilizer. And there's another 3 segments as well. I think every chemical from agriculture.
Not fragrance, because we are not into making any tertiary chemicals. We make raw materials in 19 which is which goes to making secondary chemical. Okay.
And you said in the last sentence that H2 will be much better than H1. You said past that H2 will be much better than H1. Do you see the same happening as of now?
Because the only logical answer I have is that because the shipping problems are now seem to be getting better. And so sales will not be impacted because of shipping problems, which we saw majorly happening in Q1 and Q2, where we couldn't take businesses because of unavailability of shipments.
And any guidance on the percentage implement can be seen?
I think it should be better. If these shipping problems, I mean, as it appears to me that we get better and better, then I think even our H2 should be better than H1.
Thank you, sir.
Thank you so much, sir.
Thank you, sir. Ladies and gentlemen, that would be the last question for the call. I would now like to hand over the floor to Mr. Siddharth for closing comments. Please go ahead, sir.
First of all, thank you all for taking time out and to listening to us and to understanding how the company is going forward and how the quarter results are. I also appreciate all the questions being asked. I hope I have been able to answer a host of the questions as expected by the audience. And first, to mention a little bit again, I think the major concerns remain again with the increasing raw material prices and the increasing problems with shipments and logistics, which I think should get better with the H2 of FY22. And with this, I would like to conclude my call and my discussion. Thank you so much, all of you. Thank you so much, Steve. Thank you so much, Ankur, for organizing it. And thank you so much, Namita, for being on it. Thank you so much. Have a good one.
Yeah. Thank you, sir. With this, we conclude our conference call for today. Thank you for